This is an audio recording of the Lendit Fintech Weekly News Show. The show is streamed live on Lendit TV, LinkedIn, YouTube, and Twitter at 5 p.m. Eastern Time every Thursday. In this fast-paced show, the Lendit News team and a special guest discuss the most important fintech news stories of the past week. Good afternoon, everybody. Welcome to the Fintech Nexus Weekly News Roundup. My name is Peter Renton, Chairman and Co-founder of Fintech Nexus, joined as always by my good friend and colleague, Todd Anderson. How are you doing, Todd?
I'm well, Peter. How are you?
I'm doing great. And back again for the umpteenth time, we have Andrew Dix from Crowdfund Insider. How are you doing, Andrew?
I'm doing well. Thank you for inviting me back. I'm kind of surprised I haven't offended enough people yet to cancel me. Right?
Yes. Anyway, let's get into it. We have a very busy week of news to get to here, so let's get right into it. Starting off with the new breaking news, really this afternoon, that FTX is closing in on a deal to buy BlockFi. And we knew that, FTX last week announced that the $215 million credit line they had given to BlockFi, and they're rumored to take an equity stake in the company. Well, the rumor is, and this was reported by CNBC, and that the CEO of BlockFi has since denied, but the rumor is that they're being sold for $25 million. Keep in mind, their last valuation was $4.8 billion. So if true, and again, Zach Prince, the CEO of BlockFi, has denied it on Twitter, but if it is anything remotely close to that number, right now that's a 99.5% haircut from their previous valuations. So what a story. Hey, guys.
It's just stunning. Not only the overall scope of it, how quickly it's happened, and how quick this contagion is really taking hold in the crypto space at a time when they've been asking and pushing regulators for clarity and wanting to become a bit more structured part of the market. And now you have this take place. It puts a lot of pressure on the crypto industry as a whole to figure out a way out of this in some ways. But it also gives a lot of ammunition to regulators, especially when you look at the actions of some of these companies and some of the ratios that they had in play here. And everyone's always critical of banks, but there's a reason why banks have certain ratios when it comes to their assets and leverage and whatnot. And so I think there's a lot of cascading things that are still going to happen here, not only to crypto companies themselves, but then after effects that are probably going to be felt for a fair amount of time after the fact.
Mm-hmm.
Yeah, crypto contagion. It's as we were discussing here earlier. It seems to be kind of the theme for the month or the quarter. I would, that's not exactly a haircut. That's like that's a buzz.
That's a wipeout, basically.
If it's true, I would be surprised if it is. And as you mentioned, Peter, that Zach has denied that. But they did have a pretty hefty valuation not too long ago. FTX jumped in, I think it was last week, and they provided them a $250 million line of credit. And there's blood in the street. It's certainly an opportunity for players like, Sam to, purchase what could be quality platforms that are in trouble. And in the tweet that Zach distributed, he didn't deny that they weren't for sale. So it does kind of sound like a deal is going down. It's just, what is the structure? Is this going to be Bear Stearns 4.0, or are we going to see something a little bit more that will make the current investors a little bit happier than what happened, back in the day?
Oh, and I'd be very surprised if the investors are happy. Like he was trying to raise money at $1 billion valuation. That was the news about a month ago, and obviously that never came to fruition. And when the sharks are circling, it's he doesn't have many cards right now. So
leverage is great until it's not.
Right.
Yep.
That's the game.
Yep. So let's keep on the Sam Bankman-Fried theme here. He's the CEO and founder of FTX. We woke up Monday with the news that FTX was exploring an acquisition of Robinhood, and then I think it was Bloomberg that broke that story, but proved to be not true. Supposedly, I'm sure there's some truth to it, but there is no formal acquisition talks happening. That's what it seems anyway. Robinhood is currently a publicly traded company valued at over $7 billion. It's a little bit different to trying to buy BlockFi, but that FTX. I mean, he has made an equity investment. SBF has made an equity investment in Robinhood. So, what are your thoughts, guys? Is Robinhood going to get bought?
I don't know if they're going to get bought. I mean, it was, the fact that he denied it so abruptly leads me to think that, there was maybe just some ideas being kicked around that were not very serious, and that someone maybe leaked it and that it got, eventually to the outlet that put it out there. And so maybe that was on the table as like, hey, what are the best ideas we have as things kind of get a little bit out of control in crypto. And it seems that FTX has always wanted to have a hold in multiple pieces of the financial space, not just crypto. And so, I don't know if Robinhood will eventually get bought, but if they are going to get bought, I mean, it seems like FTX is the darling right now. It's, SBF has really staked his claim in the space, and I wouldn't be surprised by a lot of things that he does.
Mm-hmm. Yeah, I've been describing him as the crypto Fed. He's the lender of last resort.
He's like the Morgan Stanley or the JP Morgan of the 1920s or whatever it was.
Yeah, I mean he sees an opportunity. Why not? I mean that's when you can really make a difference, is if you find a quality operation and it's unrealistic valuations to the downside. I don't see him going after Robinhood due to its current valuation, at least not right now. It was kind of a non-denial denial. But that also makes me wonder what's Robinhood's next step. It was a darling for the markets. They went public at a hot time. And they've just, I think they IPO'd at $38 a share, and now it's trading under 10. Yeah. There's a lot of value destruction there. So everybody's in a world of pain right now. You got to tough it out. You got to make it through. But what are the next steps to growth? Robinhood did make the acquisition. I think they made the acquisition in the UK to kind of expand their operations into Europe.
Mm-hmm.
But what's that next play? How do you get back to where you were and grow from there? And I think everybody's kind of struggling with that right now.
And FTX FTX also said that they wouldn't do payment for order flow, and that's Robinhood's business.
Yeah,
and so even that dynamic is total opposite.
I'm supportive of payment for order flow. I think that's how you get to zero fees, and by regulation, you have to have the offer the lower price to the traders. And sure, there's only a couple players in the space, with Citadel being the largest, but there is competition there, and it has been effective. I mean, back in the day, you had to pay $50 a trade, and now you can pay $0. Are the spreads larger? Probably in some shares, but the spreads are pretty tight on high liquid shares. I think it's a good thing. I think it's a mistake that the SEC is going after it.
It's a good thing in a really liquid market like our market here.
Yeah.
I think I agree with you, Andrew. So anyway, let's move on because we want to keep on the crypto bloodbath theme here, and we're going to talk about Celsius. Wall Street Journal had an in-depth piece about them, and then Matt Levine from Bloomberg, I get his newsletter, and he had a really always entertaining kind of take, basically talking about Celsius has they have these they have a lot of large loans backed by sometimes obviously you talk about over collateralized loans sometimes. Well, they apparently had under collateralized loans where they're basically talking we'll give you $1 billion, or say this for example $100 million loan, but we'll make sure you give us $50 million in collateral. So that's the type of thing that they had as a way to kind of get the deal, but coming back to bite them. It's fine when the market's sort of steady and or going up, but in these sorts of markets, it's bad. I mean, Celsius feel like to me they're done. There's talk about a bankruptcy filing. Someone may swoop in and buy them for $25 million, but it looks like there's a lot of pain still to come with Celsius.
I mean, not even the ratio of like 19-1, which I think the story in the journal had. Yeah. And banks, I think, are 9-1. But also the instruments that they were putting money into were highly illiquid. Right. And, they had to wait. And in some cases, they could not get their money out of those instruments. And it's like, if you're going to go out there and directly lambaste the banks, wear all these T-shirts that the banks are not your friends and everything. Like
that's right. Yeah.
You can't be this. In some cases, it seemed like they were pretty reckless.
Yeah.
In what they were doing, and it's just. I mean, I made the point in the first story. I mean, the regulators are going to clearly put guardrails of, all right, you can't exceed this ratio. Because these examples are just making some pieces of the market so clear that hopefully this obviously won't happen again to the next firms that do this. But in some cases, it's just self-inflicted.
Mm-hmm.
It was funny. Crypto Twitter this week, somebody was tweeting out that they saw Mashinsky, taking a plane out of the country. kind of saying that he's on the lam, which I do not believe, but it does sound like they're in a bad place. I've seen the write-ups where they've engaged with the attorneys and advisors to, view all their options, their proverbial options, which don't look good. I agree that at some point in time, there's going to be, stricter regulations around this entire ecosystem. It's just that, between the Congress and the regulators, they can't figure out, who wants to do what and which ways it's going to go first. And so until then, it's a challenge. And I do think that this just highlights the enormous opportunity for reg tech. If there's a digital first financial services industry like this, it's an enormous opportunity for self, regulation, which I have absolutely no confidence that they will get something like that done. It's unfortunate, but it's true. Counterparty risk is a huge thing, and they've bollocksed it up, and it makes everybody and everything look bad. Shame on them. Shame on Luna. Shame on Terra USD. Shame on the people that got overextended and they levered up too much.
Yeah. Okay, so we'll have one more round of bad news here before we get on to other stories, and that's the NFT giant, or the leader in the NFT space, OpenSea, has had an email data breach. Seems like one of the vendors that they use misuse their access. They shared email addresses with a third party. It's not that big a deal because it seems like it was just email addresses. And I have an account at OpenSea with my personal email address, and they have apparently 1.8 million users. So if there's no other data, if they just get emails, not that big a deal. Everyone's got my email, but still not a good look. Not a good look for the.
It's not Ashley Madison, right?
No.
I mean, in some ways, it's just about optics. It's just a bad PR piece that they have to deal with, as long as it stays just emails and not other PII. But I mean, this is the risk that you take when you work with different vendors, and I mean, a small mistake can turn into a giant problem if your systems and everything are not completely buttoned up. And I mean, I don't know, what specifically happened here, but hopefully it's not anything beyond just email addresses.
Yeah, it was a vendor theft, and but on the other side, OpenSea has been hacked a couple times now, and then more recently there was an employee who was gaming the system because he knew which item was.
He's in trouble.
Yeah. Now he's in trouble. That's correct. But I think in this instance, it's kind of minor. All my emails have been hacked, stolen. They're all over the dark web. I've given up on any sort of anonymity. People try to hack me every week, and I'm surprised I have any hair left. So it's just the name of the game. Everybody gets hacked at some time, I guess.
Yeah. Anyway, let's move on. We've got. I want to talk about the Cambridge Centre for Alternative Finance, an organization both you and I, Andrew, have been supporting for many years. And you wrote a piece about their new report. This sort of came out of they did a rapid response report when COVID first hit, and then this is a more in-depth piece on exactly what happened in really in the fintech space globally. It's certainly the most extensive report that has ever been done. 1,448 fintech companies across 192 jurisdictions are in this report, and it's mostly good news. Basically all areas of fintech seem to do well in from 2019. It's basically taking 2019 numbers, comparing to 2020 numbers. And this is a report that Cambridge did with the World Bank and the World Economic Forum. And you wrote about it, Andrew. What are your thoughts?
Yeah, no. First of all, I think it's awesome that you guys at Fintech Nexus and previously, Lend It have always supported this, because I think that it's the top independent group for researching fintech in general, and I think the industry was really needed that. So I've been very supportive of it, and thank you for supporting it. I think that kind of the top line takeaways here is that COVID was good for fintech. It was it was fertilizer on growth, because some people got locked up or locked down, and nobody was going out, and nobody wanted to go to the bank branch, and it just kind of boosted the entire industry more so than they initially anticipated. I think the big winner, payments. I mean, payments, they had a 20 or 30% increase from 2019 to 2020. Online lending, I was kind of surprised, showed a nice boost. I kind of remember online lending from the days of lore when China had all these hundreds or thousands of P2P platforms that were mostly frauds. But online lending's a big deal. And then there's some other encouraging aspects of the global fintech center, which are industry, which are very encouraging. So it's a long report. I recommend that everybody read it. There's something for everyone. I need to go back and reread it, but it's very interesting. I find it very interesting.
And going to have to be another report in the next couple of years on kind of the impact of the recession.
Yeah, yes, quite likely.
Following on this report.
Yeah, and I know a lot of the history of this report, and it did take a long time to get over the line. It's to 2020, and there was politics involved, and I won't get into that. But I would say that the interesting piece, another interesting piece around it, it seems like major inroads were made when it comes to this is globally women and low-income households being using fintech offered for the first time. Huge inroads there, I think, were made, particularly in the less developed world. So kudos to Cambridge.
As Andrew said, just to tie it off, Peter, if anybody wants a top-notch resource for fintech research and whatnot, it doesn't get better than the CCAF.
Yep, they're awesome. Okay, moving on. Amount, who we know well. They've been an opening keynote speaker at our USA event when we were doing it virtually. I think it was last year, wasn't it, Todd, or the year before?
Yeah, Mount and Barclays.
Mountain Barclays last year, I think it was. So anyway, they were spun out of Avant. They're basically a banking as a service, lending as a service type company. Done a whole bunch of stuff in the buy now, pay later space, but they have laying off 18% of their staff. They didn't say exactly how many that was, but it's significant, and they were a unicorn. I don't know if they still are, but they do have a lot of. They're basically, their target market is the large banks, and they've had some good inroads. But clearly, despite the fact they're doing a lot of like buy now, pay later and digital lending, they are not immune. I was actually surprised because I felt like they had big banks in their sights, but they weren't immune to the general downturn in fintech, it seems.
Yeah, I think it probably has to do more with the fundraising market for the foreseeable 12 to 18 months, in that they're prepping themselves for not being able to just go out and raise money. And I think a lot of investors, Peter, you talked to Matt Harris about this at our event, that it's just not going to be easy to raise capital, especially for the growth stage companies, and they need to make sure that they are cutting anything they deem as non-essential, and really tighten things up for this time period until things start to kind of go back on the upswing. Because going out to raise a 80, 90, $100 million round is going to be nearly impossible right now.
Yep.
I think that it's still kind of the tip of the iceberg. We've seen several other fintechs, some crypto firms, cut or pause hiring or rescind offers. I think we're going to see more of that. I think we've got, depending on how inflation shakes out, the Fed's going to raise rates again here next month. Clearly, whether it's going to be 25 or 75 basis points, I don't know, but that's all starting to bite, and people are pulling back. It's inevitable. Gasoline is too high. Our current administration is not doing what they need to do to tamp that down as aggressively as they should, and that factors into everything. And you're just going to have a kind of across the board cooling. It's just going to be a bumpy road for the next 6 to 12 months, depending on how certain things
hopefully no longer than
out.
that. Could be.
I mean, I have my opinions on that, but nobody knows. Nobody knows.
Okay, I want to go to our next story, which was something that really interested me from American Banker. And this, I don't know if you were following this, Andrew. I certainly wasn't that closely, but the SEC puts out these staff accounting bulletins from time to time. Generally, they're not that noteworthy, but this was something that was staff accounting bulletin number 121. It's causing waves at banks that are interested in crypto, because it basically says you must treat any custodied crypto asset as a liability, which means you have to hold reserves against that, which means it's really unattractive for banks to basically custody crypto. And it seems like there's not a whole lot of thought put into this, and there's a lot of pushback from the banking community, and it's becomes sort of this, banks are wanting to get into this space, but they're not going to do it if it doesn't make any economic sense.
So I have been following this. It's been ongoing for a long time. Actually, when I was in Manhattan at your event, I had a meeting with somebody who's in the community, and we had a long discussion about what is going on in regards to the regulatory approach at the SEC. And since that time, I've spoken to several other people, and there's just a real grim perception about the regulatory approach of the current commission. and that it is not innovation friendly. It's not digital asset friendly. And they're in fact doing things in a way to make it impossible to execute on your mission, because so many of these proposals, rulemakings, they're intertwined. One impacts the other, and they have all these proposals out there right now that are ongoing. How do you manage one when you don't know what the other one is going to end up at? It's nearly impossible. It's just, they're flooding the zone is what's happening. And you make it to such a degree that it's impossible to manage. And it's not just digital assets. I was speaking to somebody the other day about SPACs and what's going on with SPACs, which is, it has its pros and cons, but that entire industry is just, they're ballistic about what's being done to that industry. And of course, it goes back to, people's opinions on Gensler. They criticize him because he's not a securities attorney, so he doesn't really understand this, but he's very political. And I've had people tell me this is the most political commission they've seen in years or decades. And there's also some grumbling within the commission because all decisions are made in the chair's office. That's what I'm hearing.
Interesting.
It makes building a company, like in this, especially in the crypto space, like increasingly impossible. It's like, how do you do things? And then not only do you have the people in crypto space not acting great right now, and there's a contagion, but then you have regulators who are just like, we have no interest in you guys being a productive part of securities markets, so we're just gonna kind of clamp down on you. And then if you get a new administration in a couple of years, it like completely frees up, and it's like the seesaw dynamic. And it's not only is it hard for entrepreneurs, but it's hard for investors to make that bet.
It's hard for everybody.
Yeah.
And, we spoke about ESG initiatives not too long ago and the current climate risk proposal. And I am all for having a good, clean environment. And I support, clean, fresh air, clean water and all that. But personally, I don't think that the Securities and Exchange Commission should be demanding disclosure on climate risk, which is very arbitrary, hard to measure, and
there's no framework. There's no framework yet.
Even if you create a framework, what you're doing is you're creating a framework for ongoing lawsuits, and it will decimate the public markets because nobody's going to want to be public. Nobody's going to want to have to go through that. It's a failure from the word go. There's a lot of people that are passionate about the environment and global warming. I get that. This is not the way to manage it. It is wrong. It will hurt these companies. It'll hurt smaller companies. It will hurt companies that are private, that service these companies. They have no comprehension as to the cost. And they even say that. They say, well, it's going to cost a lot of money. It's just, and they're going to make a rule on it. They're going to make a rule. Somebody off the record told, whoa.
Anyway,
lost you there for a second.
No, you're good. Let's move on. Last story. I actually wanted to talk about the article from Ron Shevlin this week about Apple, and he basically said how Apple will boost the Apple Card with buy now, pay later. Because there was, we talked about the Apple Pay later, the NPL offering, talking about how it's going to potentially impact Apple Card users. But Shevlin was arguing that it's actually going to be great for Goldman Sachs. It's going to be great for the Apple Card. It's sort of like he calls BNPL training wheels for credit cards. So it's sort of getting going once you get a bit of history with BNPL. If you do Apple Pay later and you get some good some really good, payment history, then you might be able to apply for an Apple Card. So, and he thinks that Apple's going to have more of an impact, he thinks, on credit card issuers than they will on the other BNPL players, which I thought was interesting as well.
Interesting dynamic that he's bringing out. I think just the Apple dynamic overall is one that is going to be fascinating to watch, and kind of that ecosystem that they're creating with Apple products and Apple Pay and Apple Card and Apple Buy Now Pay Later, and it's going to be a force to reckon with. Whether or not they go full on and go Apple Bank is probably still a pipe dream right now. But you never know. I mean, it's been an interesting journey thus far for them, and I wouldn't put much past Apple at this stage either.
Yeah. So 15 years ago, they introduced the first iPhone. So
that's right. 15 years ago yesterday. I got mine 3 days after it launched.
I was right there with you. I mean, and it was transformational for me. I mean, I immediately said, this is what I need, and it's been an awesome experience ever since. And over 1 billion people agree, because they have over 1 billion iPhone users, and they have almost 2 billion iOS users or device users. So they're in a good spot to provide a lot more in the service side. And I agree with what you said, Peter. This is kind of the first step in providing additional fintech services. The next thing on the list will be subscriptions for devices like an iPhone. You're going to be able to basically, pay a monthly fee, and you get a new iPhone every year, every 2 years, and it'll be a credit play, a financing play, and they'll run the numbers. Goldman will help them out, and it'll be a success. But then they're going to start looking at other things, because they have access to the data. People trust them. They're big on privacy. Everything is, you're not the customer, our products are the customer for you, as opposed to the competition, Facebook, Google, etc. They're really in a good position to offer more financial services to the masses. How far they will go with that, I don't think they really know right now, but right. Credit is a no-brainer. I mean, it just makes sense. They're going to do it. Are we going to have an Apple Bank? I hope so. I don't know if we will. I think that if they do it, it'll come through some sort of acquisition. But you know how Apple works. They don't, necessarily are not the first, but when they get into something, they do it right.
Right.
And then they kill it.
Mm-hmm.
Yeah. Okay. Well, with that, we'll have to leave it there. Thank you, Andrew. Thank you, Todd. Thank you, all of the listeners and watchers. We appreciate you, and we'll be back same time next week, 5 p.m. Eastern time. Watch it live on the streaming platform of your choice: YouTube, Twitter, LinkedIn Live, Facebook, you name it. We're there. Thanks, everybody. Have a great long weekend.
Thank you, Peter. Thank you, Todd.
Yep.
Thanks, Andrew.
Happy 4th.